After you record the transactions, you post them to the ledger, okay, or the T account. So we have these transactions here. Okay, on the first, started a business with 10,000 in cash and put in a motor vehicle worth 30,000 into a business. Okay, so as I said, always the first thing you need to do, you need to ask yourself, what is going on here? What is going on here? So this person is starting up a business. Okay, so when starting up a business, which accounts will be involved? Okay, we have the cash account, because those 10,000 put in cash. We have the motor vehicle account, okay, and we also have the capital account. Okay, so cash is an asset, motor vehicle is an asset, capital account is also an asset account. Okay, so we'll find out which ones are increasing, which ones are decreasing. Okay, so we're going to use the double entry rules. So since we're putting in cash, cash is increasing according to the double entry rules, as you can see here with this diagram I told you how to use. Cash is an asset. This A here is assets. Increasing an asset, you debit. Okay, so cash is an asset, motor vehicle is an asset. Okay, so increase in assets, you debit. Then capital is this C down here. Okay, capital is a capital account, and it increases with credit. Okay, so the journal entry is going to be like this. You debit cash, motor vehicle. Okay, cash debiting 10,000, motor vehicle debiting 30,000. Okay, then you're crediting capital. Capital, you add 10 plus 30,000, that is 4,000, because the capital is also increasing in the business. Okay, so after you've recorded this journal entry, now we're going to post to the ledgers. Okay, so you need to open up the cash account, the motor vehicle account, and the capital account. Okay, so we start with the cash account, right? So you can say this is the cash account. Okay, remember debit is on the left, credit is on the right. Okay, so we debited cash 10,000. Okay, so on the date, it was the first. Okay, details, you're going to put the other account which was in this transaction. Okay, and that is capital. Okay, then here on the amount, you're going to put 10,000 for cash. Okay, yes. Then for motor vehicle, you do the same. Motor vehicle account, MV, date, the first, details, capital again. Capital, so we put here on motor vehicle 30,000. Okay, so we're just following what the journal entry has told us. Okay, we've debited cash, we've debited motor vehicle, then we're crediting capital. Okay, capital, date, you put here on the first, details, you put motor vehicle and cash here. Okay, yeah, we can put it like this. You can put here cash 10,000, capital, motor vehicle, 30,000. Any questions, colleagues? Okay. Next, of the next transaction, purchase goods worth 1,500 and paid a delivery fee of 300 kwacha, or paid in cash. Right, so what transaction is going on here? We are buying goods for resale and also paid for their transportation expense. Okay, so the accounts involved here: purchases expense, carriage inwards. Okay, carriage inwards, whenever you are bringing in a good, when what is goods are being delivered to you, the transportation fee that you're going to pay. Okay, so purchases and carriage inwards are expenses. Okay, then we also have the cash account. The cash account is an asset. So after we identify the accounts that are involved, we are going to now see which ones are increasing or decreasing. Okay, so expenses, whenever you incur an expense, that's like an increase in the expense. Okay, so expenses increase with debit. So you debit the purchases expense and you debit also the carriage inwards expense. Okay, both of them are expenses, so they have increased. Cash is an asset. Now, since you're paying out cash, it means the asset is reducing. So a reduction in an asset, you credit. Because an asset increases with debit, so it means it must reduce with credit. Okay? So our journal entries here, you debit purchases expense, purchases 1,500. Okay. Carriage inwards, debit 300. Okay, then cash, you credit 1,800. Okay, 1,800. So after you post, after you generalize this, you're now going to put this in the tier accounts. Okay, so the cash account, we already have it here. So the cash account, we're crediting it 1,800. Okay, so we say date, this was the second. Okay, so details, you put first purchases here. Purchases 1,500. And then here, carriage inwards 300. Okay, that's how you put this in the cash book. All right. Then open up purchases account and the carriage inwards account. So here we have purchases, date, second here, details, cash. Okay, amount 1,500. Okay, then you have carriage inwards, you debit. So you see here on the second, you're going to put cash. You're going to put here 300. Okay, colleagues, that's the next section which we're doing, posting to the ledgers. So it's just following there. Whatever the journal entry says, you follow it. All right. So here's the last example that I'll give. purchased goods on credit for 1,800 from CR1. Okay, so CR3 actually, CR3. Okay, so here this is a credit purchase. Okay, our earlier transaction was a cash purchase. Now here it's a credit purchase. It means there's no cash exchanging hands. Okay, so the two accounts that are going to be involved is the purchases expense and the trade payable account. Okay, the person who bought from CR3 is our creditor. We are owing him money because he bought on credit. So he's a liability. Okay, creditors or trade payables are liabilities. Liability is what you owe. All right, purchases is an expense. Okay, remember, according to the accruals concept, when you incur an expense, even though you don't pay for it, you record it. Even when you earn revenue, even though you haven't received money for that, you record. That's the accruals expense. So, again, we debit purchases, 1,800. Okay, increase in an expense, you debit. Okay, by using these double entry rules here. Increase in an expense, you debit. CR3 is a liability. Increase in a liability, you credit. Okay, so you credit CR3. $1,800. Yes. So again, when we come back to the ledgers, purchases, you're going to see on the 3rd, we debit CR3. What was the amount again? 1,800. Okay. Then, let me see, purchases. Oh, we have to also open up CR3's account. Okay, I'm going to put here CR3. Okay, then you're going to put on the credit side, we are owing him, so CR3. Credit side, we're going to put on the 3rd. You're going to put here purchases. Okay, 1,800. Okay, so colleagues, once you are done with this, let me just illustrate. Once you are done with posting to the ledgers, once you are done with posting to the ledgers, the next thing is you need to now make your trial balance. Okay, you need to make a trial balance. Okay, the trial balance is going to make sure that the journal entries that you did and the postings that you did, okay, the postings that you did, they are accurate, they're arithmetically accurate. Okay. So a trial balance is also easy to make. Okay, trial balance has just got a debit side and it's also got a credit side. Okay, then you have here where you put in your details. Okay, that's how a trial balance works. So let me show you how to how to close these accounts and post to the trial balance. Okay, so you have to know the difference between permanent accounts and temporal accounts. Permanent and temporal accounts. Okay, permanent accounts are the assets, any asset account, liability, and capital. Okay, the assets, liabilities, capital. These are permanent accounts. Okay, what I mean by a permanent account is they always, at the end of the year, you're going to carry on the balance to the next year. Okay, so for example, Here cash is a permanent account. So let me show you how you close a permanent account. All right. The first thing that you're going to do when you're closing a permanent account is you're going to first total up both sides. Okay, you total up debit side and total up credit side. Okay, so if we total up the credit side, 1,500 plus 300, that is 1,800. The total of the debit side, 10,000. Okay, so you're going to see which one is higher, debit 10,000 or credit 1,800. It is obvious the debit side is the higher amount. Okay, so what you do, you're going to put here the 10,000, put it here and here. Okay, so all that I'm doing here is I'm just subtracting the amounts. Okay, so don't get confused of what's happening here. All that I'm doing here is I'm just subtracting the amounts. Okay, so this is how we subtract the amounts. After you found out which one is high, the debit side or the credit side, okay, you go to the lower side. Okay, in this case our lower side is the credit side. Okay, was 1,800. Then you're going to put the 31st. Okay, because it's usually the end of the year when you're closing these accounts. Okay, so you say 31st December. Okay, you're going to say balance carried down. Okay, balance carried down. Okay, meaning here we're just subtracting debit 10,000 minus credit 1,800. Okay, so 10,000 minus 1,800 is 8,200. Okay, so the balance carried down is going to go on the lower side. Okay, the credit side is the lower side, so the balance carried down will come to the lower side, the credit side. Then at the beginning of the new year or the new period, you're going to say 1st January, balance brought down. Okay, balance brought down. Okay, you're just going to bring this 8,200 here, 8,200. Okay, so all that has happened is we've just subtracted the total debit minus the total credit. Okay, then to post this on the trial balance, where the balance brought down comes, that's where you're going to put in the trial balance. Okay, so for this cash account, on the trial balance, we're going to put here cash. The balance brought down was on the debit side, so we're going to put here debit side 8,200. Okay, colleagues, where the balance brought down comes, that's where it's going to go on the trial balance. Any questions before I move further? Okay, then we've got temporal accounts. These are the expenses and revenues. Expenses, revenues, contra expense, contra revenue, expenses, revenue. Yes. These ones, at the end of the year, you have to bring back the balance to 0. Okay? Because you cannot carry on with revenue for 20, let's say for example, revenue for 2025, you bring it also in 2026. No. Okay, so when the year ends, these accounts, you need to close them, bring the balances back to 0. Okay, so here carried inwards is one of the temporal accounts because it's an expense. Okay, so for these temporal accounts, all right, where the amount is, that's where it's going on the balance sheet. Okay, so here this amount, this 300 kwacha, it's on the debit side. Okay, so you're just going to put here carriage inwards. carriage inwards. Debit side 300. Okay, debit side 300. Then the way you close this account, okay, because you're first supposed to close then post, but the trick that you just need to remember is where the amount is for a temporal account, that's where it's going on the balance sheet. Okay, so for carriage inwards, have you seen the 300 here? It's going to on the trial balance. The 300 here is going on the debit side of the trial balance. Then to close this account, you just credit it. Okay, you just credit it here on details. You just a profit statement of profit or loss or income statement. Okay, and you just credit the same amount. Okay, since there was a 300 here, so to close this balance we just need to credit it with a 300. So 300 minus 300, balance brought down, balance brought back to 0. Okay, so and this 300 you put it at the bottom like this here. Okay, so you have closed this account. Okay, another illustration here, purchases here, another temporal account. Just get the total 1,500 plus 1,800. You get 3,300. Since this is on the debit side, so on the trial balance, purchases, you put here purchases. $3,300 debit side. Okay. And then how you close this account? Just remember, since the debit side is a total of 3,300, so you're going to credit this account. Okay, credit the income statement, IS. Other books you see PL. Okay, statement of. Okay, so you credit it 3,300. Then you brought back the balance to 0 for purchases, meaning the next year you're starting at 0. Yes, colleagues. Any questions?